Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Monday. It's January 9th. It's about 8:17 in the morning. The market's going to gear up to open in an hour and 13 minutes to be specific with you. Now, I know the year has already started 9 days ago, but today officially is the real first day of the year as far as the stock market's concerned. And I'll show you what I'm talking about. If you look at the trading action over the last 3 weeks, since the week before Christmas started till Friday, you will see, as I'll show you right now, this has been the trading action right here. No joke. This has been the trading action since December 15th. Look at that. So even Friday's huge move still kept us within the line of randomness, which is why I'm not so focused on the upside we saw on Friday, because again, it's still within the range bound zone. Now, if we get out of the zone and we go higher, which I'm not sure we will, I'm actually doubtful that we will, I think we're going to break out lower. And if we do break out higher, I think we're going to break out, have a couple of false breakouts, and then head lower. But the bottom line is we still are in a random range. Don't get so excited about Friday, because look, this is an hourly chart for the last, let's see here, 15, 16, 27 days. Look at that. So today's the final day that we're going to start seeing some trading action. So I'm expecting volatility to begin picking up, and also there's a lot of Fed data on the agenda. Powell speaking tomorrow, Mr. I'm not going to be honest with you till I'm reappointed. Then you've got CPI data on Thursday. You got consumer sentiment after the CPI data, which is the dumbest thing in the world. You've got petroleum status report, import and export prices. So there's a lot. Bullard speaking, Thomas speaking, Harker speaking. You've got a lot of Fed speakers this week. And as you can see here, the bond market is already cooling off and is already down. That's going to put pressure on the stocks, because remember, if we can't go higher, that puts more pressure on higher rates. When this goes higher, less pressure on tech stocks. When this goes lower, more pressure on tech stocks. And today we're already lower 1.14. Now, I would really love to see this higher, because I would be looking to short the bond market, but I don't think we're there yet. Let's see here. Yeah, see, RSI is not at that level yet. I want to see RSI up here before we sell bonds, and we're not there yet, and I'm only willing to take the short side. Another major factor you need to pay attention to, and this is a positive factor. Remember I said the energy markets are not done just yet? Well, guess what? They are today, finally, for the first time first time in over a month. They're trading above the 50-day moving average. Now, that's fairly significant for me, because I believe energies are going to rally and make new highs again. And this, to me, looks like a consolidation. This doesn't look to me like a downward spiral, kind of like what we saw here. So to me, it doesn't look like anything has drastically changed. In the bond market, I still think the long-term trend is bearish. I think this is just a little pull-up. And looking at the energies, I think energies are rallying again. And if you look at the major sectors, look at where the strength is: industrial, energy, financial, materials, healthcare, consumer staples. The top sectors are all still defensive. Now, let's talk a little bit about pre-market and see what we can expect for this week, because this is a real week where we're going to get a little dose of reality, especially from the Fed. U.S. benchmark indices closed sharply higher on Friday after crucial U.S. job report pointed to cooling wage growth, and data showed slight contraction in service activity, easing fears about a more hawkish Federal Reserve. Yeah, don't hold your breath. They're going to be pretty hawkish. U.S. Labor Department reported non-farm payroll rose 223 jobs last month, above their estimates of 200,000. Now, folks, the number has been between 200 and 250,000 all year and the year before. Nothing has changed. It's not really that cool. So take it easy before you make big expectations or markets going 700 points because of this report. This is totally in line with expectations. Less than expected earnings, they were expecting a positive 0.3% month, down from 0.4% in November, easing worries about wage growth spiral. I mean, this is just so random. It's not even worth talking about. They're trying to make something out of something that's totally random. ISM non-manufacturing PMI fell for the first time in more than 2.5 years to 49.6, missing expectations of 55. Atlanta Fed President Bostic said on Friday that the latest U.S. jobs data did not change his outlook. Of course not. It's not even it's right on target. And reiterated the Fed would need to rate hikes further and hold them at the peak until well into 2024 to cool inflation. Did you guys hear that? Anybody who thinks this a bull market is on the way should read that again. Also, Bostic said he expects a quarter or a half percent point rate increases at the next policy meeting. So 0.25 is now again at 76 and 0.50 is now at 23. Remember, this went up to 40-something% last Thursday. So it's still moving back and forth. Now, in the coming week, I think Thursday, let's confirm, yes, Thursday, we have CPI data, which will highlight as investors look for further clues about the size of the Federal Reserve's next rate hike. In addition, market participants will be eyeing other data such as core CPI, initial jobless claim, import prices, consumer expectations, and sentiment. Now, in Europe is happy about China reopening. The move is likely to boost the country's economic activity, which would have broader impact given China's importance as a crucial market for European exports. Absolutely. And China Shanghai closed higher after the country reopened its international borders on Sunday. Mazel tov. The move marks Beijing's largest pivot away from its severe COVID strategy, which has been completely unsuccessful, which hammered economic growth in the country for the past 3 years, and them closing down had very little to do with anything. As far as movements, Weibo rose 4%. Goldman Sachs upgraded the stocks. That's ticker WB. Alibaba gained 5%. So you may be seeing some upside on WB and Baba. And XPEV dropped 1%. So XPEV down 1%, Baba up. And MetLife is down also. So keep your eye on the insurance companies. As far as earnings today, you've got Tilray, the pot company, Jefferies, and Concentrix. Nothing really crazy while we're waiting for the market to gear up. Now, the S&P, we are right now at a very, very crucial level on the S&P. Now, I personally do not believe there's a lot of follow-through. And if you look at the range on the NASDAQ, you will see that that range is still, look at that. Let me just move this lower. There we are. So be very, very careful and don't get trapped into a bullish move because we're still well below the 200-day moving average. So even if we do break out and go up and rally to this level up here that starts at right here, we're still below the 200-day line. So I'm not expecting anything major. And when we look at momentum levels on the NASDAQ, I want to show you this. Look, the 200-day information technology, 39%. Real estate doesn't really count. Communication services, 36%. Information technology, where is consumer discretionary? 57%. Not that great. But energy, 74%. Industrial, 74%. So a lot of these are still very, very vulnerable, and that's because of interest rates. Again, I'm not expecting this market to really rally too much. And when you look at the major index, I want to show you that the main movement, if you look at it on a monthly basis, the main direction is still kind of around here. It still hasn't fully sustained itself. So I don't know if this is going to rally back up or just pull back up like it did here and come back down. But if I was a betting man, based on what I am seeing with the S&P or the Dow, which I'll show you right now, based on what I'm seeing, I think this thing is just going to come right back down. I would be following the S&P more than the Dow. The Dow's a little overbought right now, especially compared to everything else. But again, look at this chart. Look at this. It's right up there. And again, I don't think there's going to be a lot of follow through. Now, today is Monday. The biggest thing you have to look at is actually the S&P and the S&P right here at these levels, because we're still in congestion mode, and I believe the market is going to cool off, not heat up right now, especially in light of all the momentum levels. Energy is still leading, industrial is still leading, financial. You want to stay with if you're going to stay in the stock for more than 5-10 days, you definitely want to be in these sectors. If you're looking for a 2-3 day swing, you can go consumer discretionary, technology, or communication services. But be very, 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 very cautious right now. Let the market show you direction. I like what we're seeing with the energy market, and there's a really good chance that energy are going to go and test all-time highs again. So if you're bullish on energy, that's the place to be. In terms of the bond market, as I showed you earlier today, the bond market's already lower. The bond market looks like it's turning down. If the bond market's turning down, that's going to increase yield. And if it increases yield, that puts more pressure on technology stock, which is another reason why I think the market's actually going to cool off today. And if you want to use the word profit taking based on Friday's close, which was actually very random. But again, don't believe that this market is just going to move up and we're going to go into bullish phase and the Dow's going to start turning above the 200-day moving average. Just not seeing that at all. Matter of fact, if you look at the Dow over a period, you will see that, let's see here, that it's right now sitting right at, here's the 200-day line and here's the Dow, and I think it's going to revert right back down and cool off. So don't be so fast. With the 700-point move on Friday, don't be so fast to jump into the market's long side. Wait at least half a day. Wait the morning session to see what the market does and if it has any follow through, because right now we're sitting in the short-term overbought level on the S&P 500. I will update you as the week continues, but right now keep your eye on this channel on the NASDAQ right here. This channel between 270 and 260, and see if we follow through, or if we're going to cool off and come back down. My money's on cooling off and coming back down, but what do I know? Now, folks, I don't think I have to tell you that earnings are a really big deal. And you know where we're starting? The earnings season again. That's right. Few people know there's actually a key time to trade during earnings season. A few people. Notice I said a few people. It's a 3-day window, 72 hours, when stocks have the potential to move the most. And that's regardless of what the overall market is doing. Listen to what I just said. 72-hour window, right? 3 days, irrespective of what the stock market is doing, which means we're not dependent on the market. T-Buzz, Tom Busby, and I, we've zeroed in on how to tap into this unique phenomena. We call it the earnings drift. Oh yeah, it's like that, the earnings drift. And we're holding a special presentation on Tuesday, tomorrow, 1 p.m. Eastern Time. That's the 10th of January, my parents' anniversary. I think it's their 53-year wedding anniversary. Jeez. So it's happening tomorrow, Tuesday, on the 10th at 1 p.m. Eastern Time. Tuesday, we're going to share all the details of the strategy just in time for the next earnings season to start, right? Click the link below. Your timing for this couldn't be any better. New Year's is starting, right? It's the 10th of January tomorrow. The market looks like it's going to break out or break down, and you know what I think about this. I think it's going to break right down, and you cannot afford to miss this out. It's brand new. It's the first time we're doing it. It's super timely, and you get to see T-Buzz and me in action together again. Tomorrow, 1 p.m. Eastern Time, Tuesday, January 10th. Do not miss out. I'll talk to you soon. Follow the link in the YouTube Wealth Press channel if you can't find it on the website. Comment, post comments. I will respond and I will answer questions for you on that channel. And you can also email me, support@marketgeeks.com. Folks, 2023 is here. Let's make this the greatest year ever in the Wealth Press history, right? With T-Buzz and me going live tomorrow, Tuesday at 1 p.m. Eastern Time. Don't miss out. Have a great day. Bye, guys. Take care and keep your eye on this. This looks like it's going to break down. Bye.